Hi everyone, thanks for joining us for part 5 of our webinar series, obviously looking at protection through jurisdictions. We are very thankful to have Geoff Dore from Overseas Trust and Pension come and run us through these things. Obviously, it's very important for clients to first look at the externalization of funds, then to look at the fees, then to understand where the growth opportunities are, how to best structure things for tax reasons. But most importantly, I think, and I think Geoff will touch on this as well a bit, is in what jurisdiction do we actually look to place these funds? Because, I mean, there are horror stories out there. There's always the question of what type of recourse is there if it's unregulated, what type of double taxation agreements do we have out there? So without further ado, I'd like to introduce Geoff. I think he's got a very insightful presentation that he'll run us through, which we'll have a few questions and answers afterwards. Thanks for joining us, Geoff.
Excellent. Thanks, Tom and Alfonso, for having me. And I appreciate the topic of conversations. It's a very interesting one. And I think, what will unfold from this is a lot to consider, both good and bad, when you're deciding not only to invest abroad, but which jurisdiction to look in. And when in doubt, speak to a financial advisor, because they're generally using compliant, regulated, well-legislated jurisdictions. So yeah, let's kick off. So I think the first thing is we all go through a journey in life, and that's our journey with wealth. The first phase really being about accumulating the wealth, so building the wealth, and that could be done through many different forms: business, being an entrepreneur, possibly family wealth, so it's inheritance, building up a property portfolio, or simply investing for a long period of time. And we slowly transition into this decumulation phase. That can be past retirement. For most people that I speak to, they are continuing with the accumulation phase till well into their late 60s, early 70s. But they do need to start decumulating that wealth. And what we mean by decumulating it is actually utilizing it to meet your needs once the salary stops or the income from businesses stops, and you actually start relying on rental income from properties or dividends coming from your investments effectively. And finally, we get to the stage of life when we are going to pass away. And we need to, at that point, ensure that we have a certainty that our family and their journey with wealth is going to be a successful one. So along this journey, we face various threats. Yeah, and let's just, for instance, say you were a bit bullish with a business agreement earlier on in life. It went terribly south and you were declared bankrupt. At that point in life, you have the time, the energy, you have the ability to reaccumulate that wealth, to build it up to the point that you can be financially secure again. So that's a credit event that happens to a lot of people. We deal with a lot of entrepreneurs, and they are in a position where they are very near to bankrupt at some points in their life, and they're looking at, how do I protect myself against this? Perhaps you're quite a bit closer to retirement. You're staring down the barrel of retirement, looking at the next 40 years, thinking, how am I going to fund this? And suddenly legislative change comes into place, which is a catastrophic event for pensions. And the most recent one I can think of is a legislation to prescribe the assets of pensions into bonds and equities of really poor performing state-owned enterprises. That would have untold impacts on pensions, specifically from a South African perspective. Perhaps there's a separation in the family well into retirement. I read a stat the other day that the age group likely for separation is between 52 and 68. I thought it was quite high, and the only reason I can think of is midlife crisis for males that has now led to them wanting to separate. But that in itself is a claim on your wealth between spouses. And then finally, a very big threat to the family wealth is when the breadwinner passes away. What financial position are you leaving the family in? For the rest of their lives, effectively. So that's a significant event. It has the ability to wipe out quite a bit of wealth, depending on how well one has planned for succession, one has planned their estate. Now, the company that I work for, we've got a very simple belief, and that is the belief that anyone that we assist has the right to a safe haven for their wealth and to protect their family's financial future. So with that in mind, you need to be in a position that you can protect your wealth, preserve the value of that wealth, and have a means of succeeding that wealth onwards to the next generation. And it's quite a simple concept, but a lot of people miss it. To pass wealth on, you have to have it. So these three concepts work hand in hand to ensure absolute peace of mind for the family. You've got financial security for investors as they near retirement or in that retirement phase, and they're 100% secure that financial independence can be granted to their children should they and their spouse pass away. So this concept of protection through your journey with wealth through your life is incredibly important. Let's see what puts that wealth at risk. And this is mainly going to be from a South African perspective, but it certainly does have a lot of global factors or considerations that come into it as well. Right at the top has to be the policy direction that our ruling government has indicated in South Africa. We've got a significantly socialist government, and you can see that spend, but there's no growing, there's no profit, there's no growth, there's no revenue from it. And you can see that through all the policies that come out. That is a significant driver. The political risk that we face here is a significant driver why people invest abroad and structure their wealth abroad. Legal claims, we've just gone through a couple of them. They have the ability to wipe out between a quarter and half your wealth in one claim. And how do you protect yourself against that? How do you protect yourself against divorce, a business claim, insolvency, bankruptcy, legislative changes? There's a significant amount of things that actually put our wealth at risk. Very high levels of taxation. Our companies, trusts, and individuals sit within the bands of the highest tax rates, very much in line with developed markets. But it's an emotional trigger for all of us because we don't see the benefit of that in infrastructure, in education, in our roads, in any kind of economic growth. And we're now reaching a point where we can't be taxed any further because you get to that marginal utility point where it'll actually have a negative effect on the economy. But we are significantly highly taxed. So it encourages individuals to invest in jurisdictions that are more tax friendly, offer tax incentives, utilizing structures which allow you to mitigate legitimately certain taxes as they arise and would have arisen in your hands. Monetary controls. Thankfully, in South Africa, our banking system is very, very robust. And I must say, I don't know if anyone saw the brand value analysis the other day, but both Capitec and FNB sat within the top 10 banks globally for brand value. That is a significant achievement for South African banks. So we don't have capital controls where we actually prevent clients from taking deposits out of banks, like a lot of European jurisdictions had, a lot of African countries have had recently, and certainly a lot of Caribbean jurisdictions have gone through. But we do have exchange control, which in itself is a monitoring of capital in and out of South Africa. Who knows? It could be done away with in the next couple of years, but right now it poses a risk because that regulation could be changed and you could be brought back to the days of your money has to be invested in South Africa. Taking it out would be illegal or be a prohibition against exchange control. And we don't have to look through too many articles online or newspapers to see that our economic factors don't paint the prettiest of pictures. Debt to GDP sitting at 80%, could be 100% by the end of 2025. And you're constantly invested in that. You are concentrated in the markets, you're concentrated in your earnings potential, you're concentrated in the currency exposure. So being able to invest abroad and diversify and structure your wealth outside of the 1% of the global market that South Africa is a massive driver to reduce the risks that we face. And then finally, this is really an issue that we face both in South Africa and registering assets abroad, is what happens when we pass away? How complex is our estate? Who is going to be dealing with that estate? What are the costs involved? What are the laws involved? Which are the countries involved? All these things can put your wealth at risk. I recently had a client that passed away in the UAE. He was a pilot. And Sharia law now means forced heirship on his assets that he had in the UAE, where he never intended to leave assets to those particular beneficiaries. You've got all these various clauses that could hinder your ability to ensure that your family's financial future is completely independent, completely secure. So this is really the driver to consider international finance centers, or as people commonly call them, tax havens or international jurisdictions. And why is it called a tax haven? You know, a lot of articles will tell you it's called a tax haven because there's no transparency in information, got lots of tax incentives, it doesn't sign up to a lot of international standards. And I don't think that's entirely fair. It's called a tax haven because it does have those tax incentives. If we refer to them as international financial centers, you'll see all the advantages that these particular jurisdictions have. The first being their economic factors are streaks ahead of that of South Africa. They'll normally have 100% employment. Their solvency and credit rating will be significantly higher than South Africa. GDP growth will be some positive factor. Tax revenue won't be, well, I mean, it'll be sufficient tax revenue collected from the individuals on the island. And that really gives them the ability to offer very tax favorable incentives to both companies, trusts, and individuals where they are non-resident to those countries but wanting to put assets and invest in those jurisdictions. They've often self-governed and self-funded, which allows them to formulate their own policies. I know of a lot of jurisdictions, specifically in the pension space, obviously where we operate, where the self-governed jurisdictions have far better policy, have a much stronger promotion of pensions than certain other jurisdictions that aren't as flexible and are governed by other parent countries, so to speak. The ability to formulate your own pension law, succession law, probate, processes of court, all of these things allow significant advantage from these jurisdictions. Incredibly important, after the Second World War, it was abolished that a country could impose its laws on another jurisdiction. So if your assets are sitting in an international financial center, South Africa can change every law under the sun, and nothing will have a bearing on your wealth that is now registered in that country. South Africa cannot impose its laws on that particular jurisdiction. It can, of course, impose its laws on you, and that is why you structure the wealth, remove it from your name, generally create a nexus between ownership and control effectively. And most of the time, and I say that very caveated, there is legitimate regulation in place. There's a legal framework to recognize the activities that these jurisdictions are undertaking, and there is a corporate governance framework that ensures it is regulated, and that if it is infringed upon, that there is recourse against the guilty party and recourse for the parties that have suffered losses and damages effectively. And you'll generally find these places or these jurisdictions are the home of a lot of financial product innovations. Remember, the stuff that a lot of you are investing in today was the financial innovation in the Isle of Man and Guernsey and Switzerland back in the 80s. So long may that financial innovation continue in jurisdictions of these sorts. And finally, they absolutely protect property rights, and there are no capital controls. There are no hindering factors to moving money in and out of international financial jurisdictions. There's no exchange control. There's no elements where your assets are not protected and that your rights are not maintained as an individual. That's really the advantages, and it's so true of many of the jurisdictions that we do classify as international financial centers. Quite a few come to mind. But we also always need to consider, because it's in our faces all the time, what happens when things do go wrong? What are the considerations that you should be taking into account when deciding, do I put my money here or there, or in the Bahamas, or down in Mauritius? Where do I go? And the first thing to look at is the legal and regulatory issues. What is always true of financially unsound jurisdictions is that they do not have a proper legal framework, and their regulatory or corporate governance is incredibly little, if non-existent. And what comes from that is a significant risk to anyone who decides to utilize products in that jurisdiction, invest money in that jurisdiction, start a company, settle trusts, because without that framework, it really becomes the Wild West effectively. You could suffer significant losses and have absolutely no recourse without that legitimate framework in place. The solvency of the jurisdiction that you have decided to invest your money in is incredibly important. If the credit rating of the jurisdiction is significantly low, you face a number of problems. You could face capital controls. You could face that your deposits are taken away from you if you're investing in banks. And the first place that comes to mind really is Cyprus. Now, Cyprus, prior to the financial crisis, was a thriving mecca for international investment, as well as property investment. But following the financial crisis, Portugal, Spain, Ireland, Greece, they all really suffered. And they all at some point had to go to the IMF. Cyprus, unfortunately, was exposed to the sovereign debt of Greece. And by 2013, their banking system had pretty much collapsed. They also had to go to the IMF. And the IMF said, we'll protect you. We'll give you a lifeline of 10 billion euros. However, you need to seize all the deposits. 60 cents on every euro needed to be seized to the bank to contribute to the bank's rescue. Now, what kind of impact would that have on you as a depositor with those banks? Someone who's giving money to the bank so that you can have hard currency exposure, maybe utilize it to buy a property at some stage, go on holiday. You couldn't access that. And I think a lot of us have family members, friends, colleagues that went through that. They had accounts in Cyprus that they couldn't get their money out of. I know I've had many clients in that particular boat. This is probably true of a number of jurisdictions. The central opaqueness around information. And one particularly large jurisdiction comes to mind, and that would be the USA. It has been classified under the world's secrecy index as the most secretive jurisdiction globally. But no one can say that because it's like the global watchdog. So shortly after that is Panama, and then Switzerland and various other jurisdictions. The transparency of information in a world where transparency has become incredibly key is something that needs to be considered as well. We have things in place, international standards like the Common Reporting Standards, automatic exchange of information, that are all in place to create equality and transparency. Now, jurisdictions that refuse to adhere to that pose a significant risk to you as well as your wealth, effectively. Global reputation. How do global authorities take a view on international finance centers? How does your country of residence view the International Finance Center? The reputation becomes incredibly important. And a case in point is what's recently happened to Mauritius. The European Union has decided that Mauritius have fallen short in their responsibilities towards anti-money laundering and counter-finance terrorism. And without those measures in place, the EU now sees Mauritius as a threat to their block trade and various investment arrangements that they may have. Now, they haven't classified that Mauritius should be blacklisted. It's only going to go ahead possibly in October, and it might not even happen. But the reputational damage done to Mauritius over the last 6 months has been profound. Tom, Alfonso, and I were speaking this morning about this particular topic and saying how whether it happens or not, or whether the EU is right or not, the damage done to Mauritius as a jurisdiction on the back of EU's actions is significant, and it will be significant for years to come. And this follows the aftermath of COVID-19. You're going to see massive job losses, businesses closing out, and moving shop to other jurisdictions. So reputation becomes incredibly important. And finally, is there a system of recourse? And recourse works two ways. There must be recourse against the person that has infringed upon you, caused loss and damage, and there must be recourse for you as an investor. Some kind of system. In South Africa, we've got compensation schemes, we've got Consumer Protection Act, we've got the ombudsman services from a financial perspective. A lot of jurisdictions have an ombudsman service as well. But what about the jurisdictions that don't? If there's any damage or suffering, it's up to you and the courts, and then you're really, asking who's got the bigger wallet. So these are substantially big considerations when you're choosing a jurisdiction. And I'd just like to highlight what can only be classified as a world-class finance center. And this not only from me, do your own research into it, But Guernsey is a jurisdiction in the Channel Islands. The Channel Islands is made up of Guernsey, Sark, Jersey, one or two other smaller islands. As a world-class financial center, has promoted its viability to support wealth management, financial services, banking, fiduciary services. For all these reasons, it's self-governed and formulates its own policy, politically stable and economically stable for over 900 years, with close proximity to the EU and the UK. It's a world-class pension center, which of course speaks to me and our business. The highest standards of regulation, complete transparency. That same index that I mentioned on the US, Guernsey was considered one of the most transparent and compliance jurisdictions from a tax perspective. There's absolute systems of recourse. There is depositor protection up to £50,000 with deposits made to banks. There is solvency protection within life companies. If you're investing, 90% is protected, which is substantially higher than most other financial centers. And of course, there's an ombudsman system. If trustees or bankers or wealth managers have done you wrong and you suffered damages, they continue to pioneer innovation. I know this from our own products that they were the pioneering source in the early 2000s for internationally packaged retirement plans. And that, again, long may that continue. And of course, Guernsey offers significant tax incentives to individuals and companies. They don't tax, or in fact, they've got zero withholdings tax for individuals, whether they're investing in their own name or through pension plans, provided that you're non-resident of the jurisdiction. So for all these reasons, and I think many more, it really is our choice of home to offer our products from. And if I can just leave you with a couple of points before we move on to the questions, which I assume there might be a couple. I think the purpose that we all look to build wealth is to create our own peace of mind and financial independence for our families. That's really what it's all about. And we've got a number of challenges in South Africa that pose significant risk to us achieving those goals. And we've gone through some of them. There are significantly more as well. And I'm sure there will be other challenges to come. So you're well within your right to invest abroad and structure and register assets in other jurisdictions. And there are a lot of jurisdictions that are very favorable compared to South Africa for all those reasons that we've mentioned. But I do plead with you, consider what is important to you when you decide on which country is appropriate. And consider the good and the bad. There's a lot of jurisdictions that might come off with financial products that are a lot cheaper, but there's a reason for that. There's a reason for products being a lot more flexible in certain jurisdictions than others, probably because they don't follow the same regulations or legitimacies. So consider all of that. And again, when in doubt, financial advisors utilize products, investment products, fiduciary products, various life products in various jurisdictions. And they know from their own requirements to be compliant and legitimate and regulated that they would only work in jurisdictions with companies that are held to the exact same standard. So when in doubt, speak to an advisor, because they would not put your assets at risk in order to put their business at risk. So thank you very much for the opportunity. I'm happy to answer any questions, Tom, Alfonso, you guys might have, just to go over some of those points. Yeah.
Thanks a lot, Geoff. I really appreciate you going through that. I mean, obviously extremely insightful. I think a lot of those points are overlooked, especially when taking the deep dive into offshore investing and having an understanding of what's out there actually. So I just want to run through a few questions, myself and Alfonso will. Here's a very interesting one: is what are the implications of investing your funds in the wrong jurisdiction? I know you touched on it briefly, but let's use the Cayman Islands as an example of a previous time that, let's say you invested in the wrong jurisdiction. What are you actually dealing with from that point of view as an individual investor?
Tom, it's a good question, because I think there's two parts to it. The first is, as an investor, what do you stand to lose? And the second is, for your decisions to invest in that jurisdiction, what actions can be taken against you? Now, I mean, looking at the Cayman Islands specifically, Cayman Islands is a funny jurisdiction. It does have legislation and it does have regulation, but it's it's packaged all under the what's called the Centralized Monetary Association, if I remember correctly, the CMA. So that looks at banking, financial services, everything under the sun. So when you don't differentiate between financial services, it's very difficult to actually have robust policies in place to ensure that things are compliant. And that's exactly what's happened in the Cayman Islands. So I guess what an investor stands to lose is everything. Yeah, what they invest there, they could stand to lose everything without without recourse. And a lot of jurisdictions like the Cayman Islands say we've got a framework to to effectively govern certain investments in financial services. But if you lose it, and that's effectively outside of our control. We don't have, you don't have any recourse against the institutions. The only recourse you would do is if you decided to go to court up against them. But you would need a much bigger wallet than a company, and you would have to fight that battle overseas where the company is registered. So you stand to lose quite a bit. The action that can be taken against you is significantly worse. That could result in tax evasion, because why have you invested in a jurisdiction that doesn't follow certain international standards? You could be seen to be hiding wealth, which has its regulatory concerns. And legal, I'm not saying criminal activity, but certainly civil action could be taken against you if you're deemed to have not really had a substance to your decision to invest in that jurisdiction. But I think for an investor, the ultimate loss would be everything you decided to invest there, you've now lost, and there's no recourse for your suffering and your damages. Yeah.
So, Geoff, thanks so much. This presentation was fantastic. I think a lot of people took some value out of it. Just one more question. Let's say, for example, you invest into, say, through ABSA in South Africa, and ABSA goes bankrupt and obviously default on all their obligations. What kind of certainty do you have as an investor compared to a company working out of, say, for instance, Guernsey, going through the same issue?
Alfonso, it's a great question, and again, you need to clarify, what is someone doing with their money? If we're talking specifically banking, while I know there's proposals, up the wazoo in South Africa for what's called a dispensation scheme, a deposit insurance scheme. At the moment, there's no explicit arrangements that would protect deposits made by a client if the bank in South Africa failed. Like I mentioned, the banking system here is very robust, and they need to maintain very strong balance sheets, and they audited on solvency and capital adequacy. But if they did fail, there's no protection there as it stands. And I don't think there will be for a number of years, because who would underwrite that? You'd need the Reserve Bank, Treasury, and some form of financier to underwrite that. And South Africa's got its own problems without having to protect banking deposits. But if we, took the juxtaposition against someone like Guernsey, Guernsey has deposit protection up to 50,000 sterling for deposits made with banks on the island. Apart from that, they've also got compensation schemes if, for whatever, your deposits with the bank are not protected by the Guernsey government themselves. And as I mentioned, if you're in life insurance products like portfolio bonds, capital redemption investments, at least 90% of the investments that you've made are protected. And Guernsey do it. It's a fantastic system, and honestly, if more jurisdictions had strong balance sheets, they'd probably do it. But 90%, at least 90% of the money that goes into a policy, an insurance policy or capital redemption bond, is actually held off the balance sheet of the life company. It's held by a third-party trustee for the benefit of that policy. So if that life company went bust, let's say, who's a group in Guernsey? Zurich. If Zurich went bust, up to, in a lot of jurisdictions, up to 90% would be protected. So anything up to 90%. But in Guernsey, because of how things are structured, at least 90% of your deposits made to that investment would be protected. So you've got significantly better deposit protection from a lot of international jurisdictions. Obviously in comparison to South Africa. Yeah.
100%. And I think there's a let's squeeze in 2 more questions before you clock off. I know people are obviously very keen to get warm and get the lights back on, but this is just a very interesting point for me, and I always like this. Whenever you receive that old message from an old school friend that you haven't spoken to in 10 years, that whole, hey, how's it going? We're both pretty certain it's going to be some type of pyramid scheme that's going to be offered to you that's going to change your life. And my question to you is, Geoff, if you do get into these unregulated schemes, the crowd ones, the carrot bars, whatever's the new fad of the month, what are the actual implications that goes wrong? Like, what recourse do you have as an investor?
Tom, you know what? I think people should take all of the FSCA's warnings as a very strong sign that a lot of these investments have no substance to them, have no value to them. You don't have to do too much digging. I can name 3 or 4 just over the last couple of months where they've been promoted, they're unregulated, their services here aren't compliant, and unfortunately, on the back of that, especially when it comes to the pyramid schemes, the people at the bottom get completely screwed over. Oh, sorry, excuse my French. Get completely done in, and it's really just the individuals, higher up that benefit. So the short answer is, don't get caught in unregulated products. But if you do end up in an unregulated product, do whatever course of action you can to get out of it. And if you've been advised to go into an unregulated product, ensure that you hold that advisor to account, because it is their recommendations that could stand to lose you significant wealth. Now, you do have recourse if you've been advised or recommended or guided into an unregulated product with our ombudsman services here, but it's quite limited. I think recent stats have shown that the ombudsman has released between 500 and 650,000 rand per determination, and some of these determinations are significantly more than that. And remember, the ombudsman can only move up to a maximum or allow you to claim up to a maximum of 800,000 rand. If your damages are significantly more than that, there's absolutely no recourse unless you're willing to take that particular company or individual to task in court. And then again, it comes down to the wallet size and at what point you can settle things. So the short answer, don't go into unregulated products. Ensure that if you're going to do things yourself, that you've done enough research to make sure that these things are compliant and regulated in your country of residence. Yeah.
100%, and I think it always boils back down to if it sounds too good to be true, if it sounds too good to be true, it definitely is. And my last question, which is the one we ask all of our hosts, is if you had 1 million rand surplus to your requirements right now, how would you invest it? And please don't say carrot bars.
Well, I'd start by giving it to Carrick Wealth and asking them what they would do. No, look, I mean, having a bit of a wealth management background and dabbling in the markets quite myself as well, I'd probably go a bit more bullish than a lot of other people. So I always think blue chip stocks globally are always a good play for majority of your portfolio. But I would also definitely look at investing a portion of that in gold. I think gold has been a fantastic store of value over the last couple of months. And as the dollar continues to retreat, it's going to be a fantastic hedge. Also, it's nice and shiny, and I like how it looks. And the other point I'd probably look at is oil, because the fundamental and the reasonable price or the fair value that you get for oil is roughly $55, $60 per barrel. And it's significantly lower than that. So you can get a lot of good value out of investing that. And things will return to normal. People will start traveling again. Jet lines will need the oil. Refineries will get going again. So you will see production, demand, supply all increase, and oil to return to its norms. And then I would really take a bit of a play on crypto as well. I mean, I wouldn't stake a significant amount of wealth on it, but I think cryptocurrencies probably in 20 years' time might be your only form for a medium of exchange and store of values. I say that with a complete disclaimer. I don't want anyone to think I'm crazy, but I think it's a fantastic medium to take a bit of a punt in the market. Yes, it's there's not a lot of fundamentals to it. It's based on demand and supply of the finite coins in circulation. But it certainly has given a lot of value to a lot of clients. And if you go to the UK, you can go buy a Maserati with Bitcoin now. You can go, you know, eat lunch in Guernsey with Bitcoin. You can go to shows in Paris and pay with Bitcoin or parts of a Bitcoin. So I think that's a nice little play as well. Yeah. So global blue chip stocks that are fairly defensive and not very cyclical. Oil, a gold ETF, certainly not buying bullion, but a gold ETF, or if you want to go bullion, then obviously buy the Kruger Rands, and a bit of a play, say 5-10% of that portfolio into Bitcoin. None of the breakaways, but Bitcoin itself. Yeah.
100%. It's a very interesting take on things, and probably different to a lot of people out there. But as you say, it's good to be bullish sometimes. But thanks again, Geoff. I really appreciate you taking the time out for today. Just like to remind everyone for next week, which will be our final part in our masterclass series with Corrine van der Merwe from Sovereign. She's going to be talking about succession planning and estate planning to make sure that, look, we've done all the things previous to this. We've externalized, we've found the growth, we've structured the wealth right, we've minimized our fees, we've picked the right jurisdiction. But how do we make sure that passover that Geoff was speaking about earlier is as seamless as possible? And I think it'll be a very interesting chat. So thanks everyone for joining. Sorry that it went a bit over, but really appreciate your time and appreciate your time, Geoff.
Excellent. Thanks for the invite, guys. Everyone have a good evening. Stay warm.